Welcome to Breaking News to Trading Moves. Our goal today is to help you quickly move through some pretty complex information and really focus on what matters for understanding how markets react to geopolitical events.
Exactly. And today we're looking at the immediate consequences of a major announcement out of China, specifically the new sanctions against some U.S. entities tied to Taiwan.
Right.
Our mission here is to analyze this event through the lens of potential market outcomes. We want to identify the sectors, even specific companies, that are either seeing more investor attention or, on the other hand, more market pressure.
We have a clear breakdown of the sanctions themselves, and then we'll get into the list of companies the market is flagging as potential winners and losers from all this friction. Okay, let's get started.
So the headline itself is pretty straightforward. China announced sanctions. These targeted 20 U.S. defense companies and about 10 individuals.
And this was framed directly as retaliation, right?
Yes, explicitly.
Yeah.
It was a direct response to a large U.S. arms package that was recently delivered to Taiwan. It's a very clear tit-for-tat signal from Beijing.
Okay, so what are the actual mechanics? I mean, if these defense companies don't have major operations in mainland China, what do these sanctions actually do?
That's the key question. They outlined 3 concrete actions,
Mm-hmm.
and they're designed more for political pressure than for a direct business impact.
Okay.
First, they're going to freeze any assets that these firms or individuals have based in China. Second, they're banning any Chinese organizations or people from doing business with them.
And the third?
And third, they're restricting entry into China for all the named individuals.
Got it. So the market reaction was, well, it was noticeable almost right away. But given that a lot of these big U.S. defense companies have almost zero reliance on China for revenue, why did the broader market pay so much attention?
That's really the essential question here. The market isn't primarily pricing in the direct business loss from these specific sanctions.
So it's something else.
It's pricing in perceived risk and future probability. Even actions that look mostly symbolic on paper increase what we call headline risk around the whole Taiwan issue.
So traders see this and think the trend of escalating tension is just continuing.
Exactly. It makes follow-on measures, maybe more disruptive ones, seem more likely down the road.
So it's less about the specific action and more about the geopolitical temperature gauge being turned up another notch.
Precisely. And this gets to the idea of a volatility premium. It just means that traders are willing to price in a higher baseline risk for certain sectors.
Okay. And how does that play out?
For defense stocks, all this tension adds a predictable layer of spending to government budgets. For companies that rely on China, though, it adds a kind of permanent discount, call it multiple compression, because the whole environment is just seen as less stable.
That makes sense. So this is really reinforcing a market theme we've seen for a few years now.
It is. You have sustained demand for defense tech, you have faster procurement cycles, especially for things like drones and missiles.
And on the flip side, any corporation with big exposure to Chinese sales or supply chains has to deal with this persistent geopolitical overhang.
That's the framework. This event didn't create the trend, it just confirmed it for a lot of people in the market.
That confirmation is a good way to transition to the first side of this. The groups seen as potential winners in this kind of scenario. And we start, maybe predictably, with the big U.S. defense primes and missile systems.
Right. The rationale here is all about long-term budget predictability. The market really values that. Rising tension basically guarantees sustained defense spending from the U.S. and its allies.
The thinking is that if there's any friction, the military will need to replenish stockpiles and modernize fast.
That's it. And we're talking about specific systems: air defense, missiles, advanced radar, command systems.
The companies that come up are Lockheed Martin, ticker LMT.
LMT, yes.
RTX, which is RTX.
RTX.
And General Dynamics, GD.
Yep. And when you talk about a company like LMT, for example, you're looking at these very long cycle contracts. The market sees these events not as a quarterly sales bump, but as a confirmation that their revenue streams are secured for, the next 5 or 10 years. It's mandatory spending.
That explains the legacy contractors. But there's also a more modern tech category identified as winners here: drones, autonomy, and unmanned systems.
This is where modern deterrence strategy really comes into play. Defense packages for Taiwan have been leaning heavily toward smaller, more survivable, unmanned systems.
Things that can scale up defenses quickly.
Exactly. So the procurement follows that strategic need, regardless of who specifically gets sanctioned. The market sees this as just another confirmation of that long-term direction toward aerial autonomy.
And the companies in this space.
We're looking at specialists here: AeroVironment, ticker AVAV. They're a leader in small tactical drones and what are called loitering
Now,
munitions.
VAV.
And
Okay.
then Kratos Defense and Security Solutions, ticker KTOS. They're focused on high-performance unmanned jets and engines. These companies really embody that future spending profile.
Okay, so from hardware to the digital battlefield. The third category is cybersecurity and defense IT modernization. It seems pretty clear geopolitical friction isn't just about physical assets anymore.
No, the digital domain is, you could argue, the highest priority for spending when tensions rise. This U.S.-China friction naturally puts a focus on digital security, on secure networks, intelligence gathering.
Across both government and private infrastructure.
Right. Every piece of that hardware, whether it's a missile or a drone, it all relies on a secure network to function.
Perfect.
So cyber resilience becomes vital.
The companies named here are Palo Alto Networks, ticker PANW,
PNW, yes.
CrowdStrike, CRWD, and Palantir, PLTR.
And it's worth noting, while these are tech companies, their exposure to government contracts and critical infrastructure gives them a defensive profile during these events. They're not like purely commercial software firms. Secure intelligence and IT become non-negotiable budget items.
So if the defense and cyber sectors are seen as being insulated from this risk, where does the pressure actually land? That brings us to the other side of this, the companies identified as potential losers.
Right. Now we move to the companies that often see market pressure, that multiple compression we mentioned, mainly because of their heavy reliance on the Chinese market.
First up is commercial aerospace with China demand sensitivity. Why is this sector so vulnerable?
Well, China isn't just a market for aviation. For commercial aircraft, it's a key long-term growth market. So escalating tensions introduce these risks around order timing, delivery friction.
Meaning the planes are built, but they don't get delivered on schedule.
Exactly.
Hmm.
And just a tougher regulatory posture from Beijing in general. This can really slow down those huge backlogs and delivery schedules.
And the names that are highlighted here are Boeing, ticker BA, and GE Aerospace, ticker GE, which of course supplies engines and systems pretty much globally.
Yep. And then we get to the really big consumer-facing names. The second category, China-exposed consumer and supply chain heavy megacaps.
This is where that idea of soft retaliation comes in. Can you describe what that actually looks like on the ground for a huge company like Apple or Tesla?
Sure. Soft retaliation is basically friction without a formal announcement. It's a kind of slow-motion operational headache. It's things like slower approvals for permits or for a new factory. It's tougher inspections at the ports for components coming in. Or it can even be a targeted turn in local consumer sentiment against U.S. brands.
So it's like a death by 1,000 cuts almost. It adds up to a real reduction in efficiency and sales.
That's a good way to put it. It's a way for Beijing to apply pressure without starting a global trade crisis. And the names vulnerable to that, given their reliance on manufacturing and consumer demand in China, include Apple, ticker AAPL, and Tesla, TSLA.
For businesses like that, smooth operations and consistent demand are absolutely critical to their valuations.
Non-negotiable.
Okay, finally, the third category here includes U.S.-listed China ADRs, that's American Depository Receipts, and other cross-border platforms. These companies can feel like collateral damage.
They often are. Geopolitical events weigh heavily on the valuation multiples for these companies. It just introduces so much uncertainty about cross-border capital flows, about regulations from both Washington and Beijing.
So investors just apply a bigger discount, that multiple compression again.
Yeah, the risk profile is just seen as too volatile. The market narrative is simple. When political risk goes up, the cost of capital for these companies goes up too, and you see that in their stock price right away.
And the companies here are ones like Alibaba, ticker BABA,
BABA.
JD.com, JD, and PDD Holdings, which is PD.
Right. They're caught in that regulatory middle.
So what does this analysis mean for you? This market reaction, even to these targeted sanctions, really confirms how high-sensitivity flashpoints like Taiwan can create rapid sector rotation based on risk perception.
The key pattern is undeniable. Defense and cyber-related stocks tend to attract investor attention. They offer stability backed by government budgets. On the other hand, companies with heavy exposure to the Chinese market often see downward pressure because they carry that weight of geopolitical risk.
So the market impact shows up in sentiment and risk premiums long before it shows up in direct business consequences.
Much faster, yes. That's the critical takeaway.
This event really highlights that ongoing tension between national security policy and the needs of globalized commercial interests. You might want to explore which other large global economies, beyond China, now play an outsized role in the supply chains of these commercial aerospace companies.
And please remember that the information discussed here is purely the opinion of the author of the material we reviewed. This is for educational purposes only. It is not financial advice, nor is it a recommendation to buy or sell any security. Thank you for joining us.